last topic of the day is about investing in brands you believe in. I am fairly new to investment. I've been really interested in it, especially during the pandemic, because I understood the necessity of diversifying my sources of income. But I mean, investment, first of all, can be so many different things beyond money. You know, it can be time, it can be knowledge, whatever resources that you have. But why do you think it's important to invest in those brands, sorry, that you believe in?
I don't really know what I meant by that or where that came from. I mean,
Interesting.
it depends if you're talking about emotionally investing or investing by like supporting, or in other words, like buying a product, or if you're talking about actually investing cash for equity in the business.
Mm,
I don't think investing cash for equity in a business is smart. Um, Highly speculative. So like if you
yeah.
asked a friend to invest in Shell, your fashion company,
Mm-hmm.
um, it's what's called an illiquid investment, which means unlike the stock market where if you change your mind, you can sell it to someone tomorrow, they're
Yeah.
holding a piece of a private company for 2 years, 5 years, 10 years until you sell it. Most
Yeah.
startups fail. So you can't get out of it for 10 years, 5 years. Probably it's going to be worth nothing. So if you're every dollar counts or every $1,000 counts in your bank account, which it does for most people, investing in a small private company, early stage company is one of the worst investments you can make.
But
Uh,
what about crowdsourcing? Like, what if I made oh, what's the name of the uh
Kickstarter.
of the main? Yes, Kickstarter.
Yep.
What if I make a Kickstarter and I'm like, hey, I need $10,000 to finish my first collection, and for every person who puts, let's say, $100, you will get this little shell thing, maybe on top of my appreciation for your contribution. But
Yeah. Well, first of all, like Kickstarter isn't investing, and it's an interesting distinction. So let's
it's
just look
not.
at two companies for comparison, and you should look into this. Like this is kind of fun to have these conversations with you because they're not hypothetical. This is actually kind of real, right?
Yeah.
There's a company called Republic dot
Mm-hmm.
dot co, and it's basically Kickstarter, except it's actually investing. So the difference is if you did a Kickstarter for Shell, we need $10,000 to finish the first season. I'm going to put in $100 or $200, and in return, I'm going to get like a piece of clothing and a little
Yeah.
shell something pin or like some prize
Yeah.
or something, and your appreciation, right? But I get it's a transaction. It's actually just an e-com site, except
Mm.
I'm de-risking it for you because a big challenge for a business like Shell is what's called yield. In other words, you have 100 pieces, are you going to sell them all? If you do it on Kickstarter and people tell you their sizes ahead of time, you just make exactly what you sold and you have no dead inventory, it's called. You have no pieces lying around that you never sold.
Yeah. Exactly.
So that's the advantage to you. The advantage to the buyer is that they get to buy something that isn't even on market yet. So they get to
Mm-hmm.
get it ahead of everyone else. They get to support, as you point out, and like help something they believe in. So that's all very cool. And they get a piece of clothing for cheaper than they would if they waited. So that's
Yep.
that dynamic. Republic, I might put $100 in and I get a piece of your
A part of
company.
my.
Yeah, I actually
Yeah.
own a little tiny piece. And by the way, you can say $100 you get a pin, $500 you get a piece of clothing and a pin, $5,000 you get like a whole wardrobe and da da da. $10,000 you get a personal CJ and I will fly to you and do a personal consultation on your fashion, da da da. So it works like
Yeah.
Kickstarter where you can give rewards and give them something, but they're actually getting a security. In other words, they're getting a piece of your company, and they're now investors, which is kind of cool.
It's cool. It's also scary, the idea of having people owning a piece of your company, especially when you just started. I'm very foreign to all of this. It's what's like a good number of how much, you know, you should allow people to own, invest in your company.
Yep.
um what I know you, I mean, with the hub, I know like you offered people equity. Can you talk a little bit about, you know, what motivated that and how you did it?
Yeah. Well, there are a lot of things there. I mean, you know, how much equity you should give away. That's a question.
Yeah.
How much you should say your company is worth is another.
Mm-hmm.
Um, let's just take the first one. So how much equity you should give away. The amount of equity you should give away should, just for easy math, right? Let's say I had a cookie. The cookie was worth $10, and I'm going to give you half the cookie.
Yeah.
Now I have $5 worth of cookie and you have $5 worth of cookie. I've given you half the company. My It would be a dumb decision unless Mizel could make the cookie, Mizel's participation makes the cookie worth so much more,
Yeah.
at least $20 total, so that my half is now worth 10 and your half is now worth 10. So your
Uh-huh.
contributions to the company, I gave you half, but you doubled the value of the business. And so even though I only have half of what I used to, the value of that half is equal to when I owned the whole thing. Does that make sense?
Yeah, it does.
So that's how you decide how much equity to give away. How
And
much?
it's based on kind of speculation. Future projection of
Yep.
how well you think your business is gonna do.
Well, but how much is the person that you're giving the equity to? It could be an investor, it could be an employee, it could be anyone. I'm giving equity. Maybe it's 1%, half a percent, 50%, 90%. It could be anything. Are
Yeah.
they going to bring so much value in exchange for what I'm giving them? Either because they're giving me a lot of money, they're working for me. It's always an exchange for something. And is the value they're bringing going to offset the fact that I now own less of the company?
Yeah. You know, I was thinking, it's funny you say that. I mean, I was thinking for Shell now, there's like definitely people that I need to hire. And there's also, I mean, I have limited means. And I was thinking about, you know, what is a fair trade? Could I offset like the lack of resources and I can offer by giving a piece of Shell, and how big it should be? It's hard, especially at a very early stage. I mean,
Yeah,
the
you
first
have to
collection
get quite
isn't even.
creative, Mizel. I mean, like, because Shell is an interesting company, right? Like,
Yeah.
it's niche, it's slow fashion. You want to really quality control, and you and
Yeah.
CJ are going to be making it by hand. So the upside is limited. So
Hmm.
equity is exciting when equity can be worth nothing because most startups fail or people give up or whatever.
Yeah.
But when you invest in like a company like the Hub, the hope is that, like, in theory, right, the Hub could be worth 1,000 times as much in 5 years as it is today. 1,000. It really could. Will it? I don't know, but it could. Could Shell be worth 1,000 times as much? Probably not, because that would involve you going mass market, probably making product overseas. Like, it kind of kills the whole brand. Could it be 3 times as big? Yeah, 5, 10. But the upside for an
Mhm.
investor or the upside for an employee is like, okay, I own 1% of this thing. Will it ever be worth 10 million? Like, will the company ever be worth $10 million? So if I own 1%, that's 100 grand that I have
Yeah.
of value. Do I believe that there's a pathway for the company to be worth that? And for a small, Shell is more of a small business than it is a startup. And what I mean by that is the size it will be a year or two in will most likely be the size it always is. Maybe,
That's why I think it as an umbrella. You know, I as Shell, like the fashion brand being a part of Shell project, being an umbrella that will grow into different things when the brand is established.
yeah, so there's something called profit sharing. So another way you can conceive of it is usually with startups, if someone owns 1% of the company, that is of no value to them. It's a piece of paper,
Yeah.
and it's only worth something when the company sells, when it's liquid. And when there's a liquidity event, then my 1% is worth something, but not until then. And so if Shell is going to be around for a long time and you don't plan to sell it, and or it's never going to get that big definitionally, the
Yeah.
value of owning 1% or 5% or anything is like, it's a lot of risk because it might be worth nothing, and it's not a lot of upside because even if things go enormously well, it's not going to be worth that much.
Yeah.
Now, if you said you own 5% of the business and every year we take the profits of the business and we split it up with the equity holders. So you own 40%, CJ owns 40%, and then you take 20% and give it to your employees. Someone owns 5%. Okay, now you've made $100,000 of profit in a year. If someone owns 5%, they make $5,000 at the end of the year as a bonus because they own 5% of the business. So they get 5% of the profits. That's called profit sharing. And so that would be a way of making their ownership more liquid, where it's actually worth something to them. So if they work really hard and the company's doing well, they get a piece of that. So it's less about the exit when you sell your company,
Yeah.
more about just annually how the company is performing.
That's very interesting.
It's hard, Mizel. Like, equity as a business owner is one of the most valuable things you have, because as you're realizing, it's cash maybe is the best thing you could give people, but equity is the second best because it can be worth a lot. It aligns your incentives and makes them feel really a part of it. But ironically, companies give away very little equity. Like, if I were to hire someone to work at the hub right now who was 28 years old, they'd get 50 basis points. That's 0.5%. So a half a percent at most. And they're like, 0.5%. That's like not even a number. That's a less than 1%. Like, it sounds insulting almost. But the idea is like, no, I mean, if you really believe in this, this could be worth $100 million. That's 500K. So giving away small pieces of a company is actually a big gesture as a business owner.
Yeah.
But employees, particularly that are new to this sort of thinking, if you were to say to an employee, I might give you a piece of the company, they're thinking like 20% in their mind. And what you're going to offer them is 1% or 2%, which is a huge deal. But to them, it sounds insultingly low. So it's sort of one of these unfortunate things where it's a big gesture on behalf of the business owner, and it's not always understood or appreciated by employees unless they've done this before.
Interesting. I want to go back to investing in general, because I think that was kind of what I was thinking about, even if it might not be in the brands that you believe in. I think investing in general is something that people should start doing very early, and now we have tools like, Acorn or Robinhood, where you can invest very small amount of money. I know that it's funny. I was with Carl yesterday, who was telling me like, "Oh, James is always talking about investing, da da da. Like, he's so into it." Um, what do you recommend for like beginners? When should you start investing? In what? With
Really
what
excited to
strategy?
I'm really excited to answer this question because I've been learning a lot about it myself. But I just to qualify, like, I've started a venture fund that invests in businesses, which is sort of where our conversation began. So I do invest in young companies, which is a huge risk because most of them fail. It takes 10 years to get your money back. It's like, so if
But
you're
you invest more than money. I'm sure that you also do consulting for these brands too.
consulting time, all kinds of stuff. But so I love that. But now you're asking me sort of about which is different. Like, Kelly hasn't heard me talk about investing in public markets. So, there's private investing, which is like private companies, like the Hub, like Shell, like Bora Bora, like any of these brands, right? They aren't publicly traded, so you can't buy a piece of them on a stock market or a stock exchange. You have to make it a formal investment in the company. So that's what my venture fund does. when you ask me about, like, let's just say for argument's sake that you had $1,000 or 10,000, let's say $10,000, maybe it's a little easier, lying around, and you want to invest. Let's talk about that.
Yeah.
And I'm only just learning about this stuff. So you tell me if this is helpful or interesting.
I'm learning too. I'm reading quite a lot about it. So I'm
Okay.
eager to learn.
So basically, why invest? Let's start there.
Yeah.
Historically, interest rates were higher. And what that means is when you need to take out debt, so you're going to take out a mortgage for a house or a loan for a car or anything, the interest that you owe every year on those payments is higher. But it means that things that pay you interest, like keeping money in a bank account, you would make like 1% or 2% a year. So you'd have your $10,000, you make 2% a year.
Yeah.
So 2% of 10,000 is $200. Now interest rates are so low that just keeping your money parked in cash in a bank account,
You lose money almost.
you don't lose money, but because of inflation, you do. It's a little complicated, but basically, like, you might make like $4 on the $2,000. Like, that's how low interest rates are. So basically, keeping money parked in cash means that it stays the same, and it's actually moving backwards, to your point, because inflation makes money less valuable over time, usually about 2% a year.
Yeah.
And so that same $10,000 isn't actually doesn't have the same purchasing power. It's not worth quite as much.
I have like a high yield saving account right now with like Amex, and when I first opened it last year, it was 1% return on investment, I mean, whatever, and now it's 0.5.
0.5, yeah. So tiny, right? Okay,
Yeah.
so that's why you want to invest, because investing gets you a much better return than that. Okay, so now let's talk about what your options are. There are really two main options: stocks and bonds.
What's the difference?
So stocks are pieces of publicly traded companies. So imagine the hub were really, really big and worth $100 million, and I went public. What does that mean? Well, instead of in the past when the hub has raised money from private investors to get bigger and bigger and bigger, I basically sell half of the company, all of the company, to a shit ton of investors publicly. Anyone in the world can log on to Robinhood and buy like 2 shares of my company or 100 shares or anything they want. Little asterisk there, Muzel. Back in the day, like the early 1900s, when a company went public, everyone that owned the stock were everyday people. So like my grandparents they'd buy some shares in General Electric or General Motors or Disney. Now, most of who owns publicly traded companies are other companies, hedge funds, private equity, and retail investors, everyday people, only own a very small percent of like Tesla.
Yeah.
That's changing because of things like Robinhood and your exact question, which is people your age are interested all of a sudden, and retail investors are coming back. Okay, so that's
and the GameStop effect. I mean, you have to talk about that too, I think.
Yeah, I'll talk about that. That's actually quite complicated, like if you actually want to understand it. But so let's just get the basics down. So
Yeah.
why are we investing? We're investing because we want your money to grow over time at a rate faster than a shitty 0.5% return a year. So the stock market, there are thousands and thousands and thousands of publicly traded companies. When people say like, how's the market doing? They usually mean there are groups of companies like the S&P 500. That's 500 of the biggest companies, publicly traded companies in the world, or the Dow Jones Industrial Average, which is 30 companies. And that pool gives an indication of how the entire stock market is doing. Every publicly traded company, it's sort of like a bellwether, an indication.
Yeah.
And so if you look at the S&P 500, it sometimes does really well, sometimes does really shitty. But if you average the past 100 years, it grows 10% a year on average.
Yeah.
So now that exact same money that you have sitting in your high yield savings account, instead of 0.5%, it grows 20 times as fast.
But that's also, I think it has to come with like what type of investment you're looking for, short term, long term, it's going to condition your investing strategy. It's funny, from what I read, I'm sure you read that book. It's called A Short Walk Down Wall Street. It's a
Oh.
very famous book from like this super famous economist, and he talks about ETFs a lot and how no matter what strategy you have, ETFs, investing in long-term ETFs is always going to be a day trading investment, no matter how. Can you explain that? Like,
No, an ETF investing in an ETF long term is the opposite of day trading. So ETF is an exchange traded fund. What does that mean? So they're individual stocks like Tesla. Okay.
mm-hmm.
An ETF is just a bundle. Sometimes it's 10, sometimes it's 100 stocks. The reason you invest in an ETF is because it's diversified. Some of them go up, some of them go down. It's
So you
less
can hold
risky.
it. Yeah.
It's less risky. And so the S&P 500 is an ETF. It's a bundle of 500 stocks. And I'm telling you that the average over 100 years, it has been that it goes up 10% a year, which is a lot. Because don't forget that it compounds. So there's something called the rule of 72. If you take 72 and divide it by your annual return, that tells you how long it will take to double your money. So
Why
70, it's just a helpful trick. It's just so 72 divided by 10 is 7.2. So
And
if
that's how
you
many years it's going to take you to double your investment?
double your money,
Okay.
if you're appreciating by 72%, 72 divided by 72 is 1. So you'll double your money in a year.
I'm just confused about where this 72 number comes from.
It's just a help. So the idea of compounding interest is like a snowball rolling down a hill.
Is you reinvest the
Yeah, you reinvest, and so it gets bigger, faster, bigger, faster, bigger, 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 bigger. And so it's growing at a faster and faster and faster rate. So it's hard. Like if I said 10% a year, if it weren't compounding, you would say that it would take 10 years because 10 times 10 is 100%, meaning it would double. But it actually doubles every 7 years because you're reinvesting and it's getting larger and larger. So let me try to zoom out again. So investing in ETFs is, if you're going to invest in stocks, it's a good strategy because it's more diversified than picking stocks. Day trading is about what's called high beta. Beta is a fancy word for risk. Day trading is all about what a lot of people do on Robinhood and why it's really dumb. Speculation. It's like, I think something's going to change a lot really fast in the next day, 2 days, 5 days, which is why it's called day trading. And so I'm going to buy it in the morning and sell it at night and literally like make a return that day.
Mm.
If you buy into an ETF, most people leave that 5 years, 10 years, 20 years and just let it run. And the idea is that sometimes the S&P 500 has in the past decade had a year with a 2% return, a year with a 30% return. When it crashed during COVID, it went down 30%. So if you own 10 grand in the S&P 500, it was worth 7 grand overnight. You lost $3,000. But if you just wait, it recovers and over time. And so that's why, as you point out, short-term versus long-term, I recommend putting money in a brokerage account and pretending that that is no longer your money. You don't need it. So you never take money out of the brokerage account for your like rent. And that way you can, if it goes down, you can be patient and make sure it rides back up. If you are reliant on that money, you might pull it out in a month where the stock market's down and your money has depreciated, not appreciated. So you want to wait and like over time and
when you deploy that though,
what's that?
I feel like, so I want to talk a little bit about compounding because it definitely has its, advantages about you make like a quicker return on investment, a bigger one, faster. But also, if you keep reinvesting all the time your dividends, it's almost that this money, is never real, is never tangible because you never use it and you reinvest it. And isn't it being a little too greedy? Like, shouldn't there be a point where you actually, take some of this money out and like actually use it? Otherwise, if anything happens like COVID, like a big like a bubble, like explode and then like boom, like you have nothing.
Well, every 7 years it doubles. So if you put in $10,000 when you're 20,
Yeah.
when you're 27, it's 20 grand. And 7 years
Mm-hmm.
later, it's 40 grand. Then it's 80
Yeah.
grand. Then it's 160. Then it's 320. So it's getting really big. And so
Yeah,
literally
but
like,
it's not in your bank account. It's there, but it's not
yeah,
really
but
there.
so the question is, when do you want to pull it out? If you pull out some of the money, it's not going to be growing as fast. That's okay. You can, I mean, like, I sell stock all the time. Like, you can sell and you can, use the cash. Ideally, you don't so desperately need the money that, again, there was a crash when COVID happened and it took 4 or 5 months for the stock market to recover. That was faster than most people predicted. Some people thought it was going to take 2 or 3 years.
Yeah.
If you're not in a hurry, you can wait and you sell off when you get back up in 3 years. If you're the kind of person that needs the fucking cash you have in her brokerage account, then the market might crash. You might be like, I got to pay rent this month, and you have to sell the stock. But now you're selling at the fucking bottom when you literally have lost money. So it's like, fuck, like I'm selling my stock before it has a chance to go back up. So conventional wisdom is like, you just put it in the fucking S&P 500, you put it in ETF, and you just ride it, man. You just ride it. And when you want to, when you and CJ want to put a down payment on a house or you're putting kids through school or something, yeah, sure, take it out then. But the longer you wait, the bigger it gets. So it's up to you, and you can
Mhm.
take it anytime you want. Um, Less risky. So a balanced portfolio, so stock makes you much more money, but it's much more volatile. It's much riskier. Bonds make you much less money, but they're much less risky. And so you just have to decide your risk tolerance.
What
Some,
are what are bonds? I'm not sure. I don't think you actually explained what it was.
yeah, so bonds are a big thing. Sometimes it's a government, sometimes it's a country, sometimes it's a city, sometimes it's a company.
Hmm.
They need cash right now for any number of reasons. A city wants to repair all its roads.
Yeah.
Normally they get money by taxing once a year. If they need money in between that, they issue bonds. If a company wants cash, they issue bonds. So it's basically a loan from the public. So they're going to try to, like, let's say the city of New York wants to raise $10 billion. They'll issue $1,000 bonds with a pre-negotiated interest rate, 3%,
Mm.
3% a year. So it will pay you guaranteed 3% a year. There are different length bonds.
I
Short
was about to say it was
short-term bonds are 2 years, 1 to 2 to 3 years. Medium-term bonds are 5 to 10 years. Long-term bonds are even longer. So you guaranteed get 3% every year, 3%,
yeah.
3%, 3%, which again, remember your high yield, which is a joke because
It's
yield means how
point
much you
five.
get. Your high yield savings account is 0.5%. A bond is 3%, 2%, 3%. So it's 6 times the return, and you get it annually. So the company's paying you interest. So or New York City or whatever, whoever issued the bond, they're paying you interest, and then they give you the principal back. So they give you your 10 grand back at the maturity date of the bond. So at
Mm.
the end of the 5 years or 10 years, they now give you the cash back. Now, what happens if it's a corporate bond and the corporation goes bankrupt or is just doing really shitty? They can default on the bond. They can default on the interest payments. So they don't pay you the interest, or worst of all, that $10,000 you put in or $1,000 you put in, gone.
Yeah.
So there are rating agencies that rate how risky a bond is. There are basically two flavors, investment grade and junk.
Mm.
Investment grade are bonds that almost certainly won't fail. The highest investment grade is AAA, and like the US government is AAA.
I think France is not AAA anymore. They've been removed like a
It
few
could be
years.
AA or something. Yeah, and then there are junk bonds, which are like usually corporate bonds that are risky companies that are raising cash, and it's like, well, they could default.
Yeah.
Junk bonds get way higher interest rates, 5%, 6%.
Yeah.
But there's a chance that the company defaults and doesn't pay you your money back. So you're getting a higher interest rate, but there's a higher chance that you lose all your cash. The US
In
government.
in comparison, like what's the interest rate for like what you call the blue chip companies? Like
The
the
blue
big,
chip
big.
stocks, blue, like now we're back into stocks. So
Yeah, yeah,
bonds
yeah,
are, maybe 2 to 5%.
yeah.
You know, Stocks can do anything. Like I've made investments that have gone up 60% in the past 2 months. But an ETF, like the market, the average is 10% a year.
No, but like I'm saying, for example, a Facebook or a Google or a General Motor. I don't know who's like
So it seems
the
like the
most stable one.
concept you're struggling with maybe is the difference between, so there's this thing called yield. You mentioned it before, high yield interest rate. Yield um, is the money you make off of the investment. For a stock, so for a bond, the two ways you make money from a bond are the interest payments every year and then getting the principal back at the end. Those are the two ways. A stock, you make money in two ways too. Some stocks give dividends. So they actually are like, thank you for investing. Here's a little reward. And it's basically what we were talking about before, profit sharing. So if a company does really well, they have a shit ton of profits. They give you a piece, they give their shareholders a piece of the profit. So you get a dividend payout. Not every stock does that.
Okay.
Some stocks, the way you make money is simply that you own a piece of stock, you paid $30 for it, and then it grows and it becomes worth $60. And then you sell it and you've doubled your money. So the market, so all of the stocks in general, on average over time go up 10% a year. So that's double what bonds go up. But this year during COVID, at one point, the stock market, meaning the stocks, went down 30%. It crashed. So $10,000 is worth $7,000 overnight. If you were all in bonds, that wouldn't have happened.
Yeah.
Right? The chances that you lose $3,000 on $10,000 worth of bond investments is almost nothing. The chances you lose $3,000 in the stock market, it happens. Like there are corrections like that all the time. So the question is, do you want to invest at all? I think the answer should be yes. The second question is, what should you invest in? And what is your risk tolerance?
Yeah.
And how long are you willing to wait? If you're willing to wait a long time, I say go very heavy if you're young into stocks. Why? Because yes, some years will be a bad return. You'll even lose money. But if you don't let that rattle you and get freaked out and like pull all your money out, and you just keep it in there, it's okay. It goes back up. And over time, if you look at the 10 or 20 years that you've had your cash in the stock market, it will have gone up. If you do what everyone's doing right now, so let me explain to you why now is a really silly time. There's something called a PE ratio, price to earnings. Businesses have profits at the end of the year. Let's say a company has $1 million worth of profits. They have stock. The stock has a certain value. The price of each piece of the stock will determine the total value, the total value of the company. The relationship between their annual profits and the value of the business is called price to earnings. What is the price of the company versus what is their earnings in a year? The S&P 500 usually is the average over 100 years is 15. So if you look at all of the earnings of all the companies in the S&P 500 and you multiply by 15, that is the value of the S&P, of all of those companies. Does that make sense? So it goes between 10 and 20. Sometimes it's 10x earnings, sometimes it's 15, sometimes it's 17, and it goes up and down. It's at 43 right now.
Yeah.
That's almost unprecedented. So what that says is that companies are dramatically overvalued, particularly tech companies, where
that's what Elon Musk, I remember one day I follow him on Twitter, and one day he tweeted himself. It was like the stock price, Tesla stock price is way overvalued, and then the price dropped.
So check this out, right? Just let's take Tesla. Tesla, their market cap, which is the value of Tesla. What is Tesla worth? It's worth more than Daimler, which is the biggest automotive maker in Germany, Volkswagen, Honda, Toyota, and one other company combined. So those five giants, Tesla's worth more than all of them combined. Those five companies are going to make 24 million vehicles in 2021. Tesla's going to make 400,000.
Yeah.
So these companies are going to make almost 100x the number of vehicles. And yet Tesla's worth more than that.
But as long as everyone believes, you know, it's like these pyramid schemes. It's like as long as everyone believes that Tesla is worth like whatever amount of money, and they keep doing that.
Yep. Then it grows, and then it grows. But what happens when people stop believing?
Yeah.
Then it goes down. And so what most people are doing your age is they're stock picking, which is really fucking dumb. They're like, here are five companies. Like GameStop is sort of a special case, and I'm happy to explain what happened there. It's a little confusing, but you know, Tesla, I believe in it. I believe in this, and I think this is going to have a really good year. And people just buy individual stocks on Robinhood. That's about as high beta as you get, as high risk, high reward, but also you can go up 60%, you can go down 60%. And there's no guarantee that it will recover as much as you want. So you can just be totally fucked if you put $10,000 into Tesla or $10,000 into 4 stocks, particularly if they're not diversified, Mizel, meaning they're all tech stocks or something.
They all have the same, like, respond to the same environment, same risk. So
And you have to remember, like, you're a retail investor. So when you buy stock, you're buying probably 1 share, 3 shares, 2 shares. If you start getting more money, maybe 10 shares. Hedge funds, private equity firms, they buy blocks. So they'll buy 1 million shares. So you're like in a little rowboat in the middle of the ocean, and all these cruise ships are going by. Like, the ecosystem that a little retail investor on Robinhood is playing in is, you're so small, and overnight a big hedge fund can be like, Tesla's overvalued, dump it, and it's gonna like create all this whole waves, and you never saw it coming. And why could you? How could you? So that's the risk, is that, and what happened with GameStop is like sort of phenomenal, really. It's
small guys said fuck it to the big guys, pretty much.
It's really a story of retail investors saying fuck you to institutional investors. It's really a story of Main Street versus Wall Street. Main Street is like the real economy, what you make, the coffee shop you go to, like the stuff on Main Street. Wall Street is speculation. Like you said, it's all storytelling and just like people being like, I think Tesla's going to be worth millions of dollars.
Yeah.
So it's a story of a lot of people getting together and fighting back. And so what happened there, what really confused, I hope what I've explained so far makes sense. That's like the stock market in its simplest terms. So again, a balanced portfolio, 60% stocks, 40% bonds. When you're young, I think you should be more aggressive personally, 80-20, 100-0. Don't fucking pick stocks. Don't like invest in single companies, invest in ETFs. I can send you some. There's another thing that's very trendy right now that I really like called SPACs. It's really interesting. So SPAC, SPAC, stands for Special Purpose Acquisition Company. So the idea is this: to go public as a company, so the hub is private. For me to go public, I have to file with the SEC, something called an S-4 filing. It's very complicated, very expensive with lawyers, takes months. It's a big process. And then I go public and I sell all of my public shares on the public market, and it's a whole process. SPACs are started by very wealthy people or hedge funds. And basically they take a shell, they take a empty thing public. So they take $20 billion and they just go public with some, and they name them silly, like, fuck you things like IPOA. IPO stands for initial public offering, which is the act of going public. So the stock, if like, you know, Facebook is FB, IPOA is a SPAC. It's a, in that case, it's a guy who took money, started a fake company called IPOA, took it public. Now it's a publicly traded company that I, James, can buy, but it doesn't do anything, no operations. And all IPOA is $20 billion of cash that is going to acquire private companies so they could buy the hub. And what does that do? Basically, overnight, it takes the hub public because I'm now a piece of a publicly traded company. So now someone who owns IPOA effectively owns a piece of the hub. Does that make sense?
Yeah, it does. So you don't have to go through all the cost you as the hub to go public. And on the other end, you can invest in like maybe like smaller businesses that are more meaningful to you, that you're more educated about, interested about. There's a big thing, I think a big thing about investing is also doing your research and like maybe focusing on one sector of activity where you really read the news about what's going on.
Yeah. So if you wanted to take that strategy, you should invest in industry specific ETFs.
Yeah.
So what are bundles of like fashion companies or something that you think their read on it, or mutual funds, Mizel, which are basically ETFs that are very closely monitored and built by like a person that manages the fund. They tend to be a little more expensive, but it's someone picking. And that's another reason I like SPACs, because it's one person and they started it and then they acquire like 8 companies. And so it's basically like an ETF because it's a diversified group of companies that are inside one thing. And it's run by someone that I respect and think is
I
really.
was about to say, it's a lot of responsibility because it relies on one person's good judgment and one person's knowledge of that industry.
But in some cases, so I don't put all my money into that, but probably 10% of my money's in SPACs. And they're people that I respect and think and know are way smarter than I am and know way more about all this stuff than I do. And so I'm diversified because it's only 10% of my money, but I'm giving that money effectively to them to make smart decisions in 8, 10 other companies. And like a lot of my SPAC investments are up 34%, 30 to 40% in the past year, for example. A lot of my ETF investments that are very industry specific. There's one woman I really like. What is her name? Kathy something. She is very tech focused, not like modern tech, very future tech. So like cutting edge, like genomics and like stuff that's very, very cutting edge. She like knows everything about them, and her ETFs are up. One of them's up 80% in the past year. One of them's up like 20. So more than the S&P 500. So
how long do you plan on when you invest in SPACs? I'm sorry to you. When you invest in SPACs, like, do you think short, middle, long-term investment?
So it's hard to know right now. Like it's a scary time because the S&P 500's at 43x earnings. That's usually the past couple of times that's happened, a huge recession's come.
Yeah.
It's an indication that stocks are just dramatically overvalued. And so it's a dangerous time to be in a little rowboat. Even if you're picking ETFs, like the market could correct. So if you're in stocks right now, you have to be prepared for the possibility. Some people are like, for sure this is a bubble, and for sure it's about to pop, and for sure everyone's fucked, and it's going to be like a couple years. So if you're in stocks right now, you have to be ready for that and be prepared to not touch this cash for 3 years. If you want to play defense, ironically, a lot of people are saying the bubble's actually in the bond market. This gets very complicated, and we are running out of time, so I'm going to skip this part. But the thing that's most complicated about the bond market, I think you understand what a bond is now.
Yeah.
The confusing thing is, if you have a 10-year bond, you can resell your bond before it reaches its maturity date. So there's a secondary market for bonds that speculates on bonds. How much are they worth? So you might have bought your bond for $1,000, you get your 3% interest, and then you get your $1,000 back at the end. At somewhere along the line, you can sell that $1,000 bond for $1,500 because the secondary market is like, we think this bond is, that company's really doing well or something. So bond prices go up and down, and you can sell your bond, you can sell your principal, and then now when the company pays it back at the end, they're going to pay back the person you sold it to, not you. So a lot of people think usually bond bubbles happen when people are scared of equities, when they're scared of the stock market, and so they move all their money into the bond market. There's a lot of speculation in the bond market, and a lot of people think the bond market's about to blow the fuck up. So the thing that's supposed to be way safer, which is bonds versus stocks, is about to have a lot of problems, particularly the secondary market.
What should we do? What's that?
I don't know. I'm asking myself the same question, and I'm learning too. I think what I'm going to do is ETFs I believe in, SPACs I believe in. So I'm diversified, but I'm still I'm still making some bets. It's not, I could just put my money in the S&P 500. I'm putting it in certain ETFs, certain SPACs that I believe in. And I'm prepared for it to go down 30, 40, 50% and the bubble to pop and everyone to freak out. And I'm prepared to not touch that money. And I'm prepared to wait 2, 3, 4 years for it to come back up. So I'm prepared for that. And so I'm going to keep in stocks. If you wanted to be able to touch that money in the next 5 years, I would get out of stocks and either keep it in your high yield, keep it in cash. That's the safest. You can't lose it. You're not going to.
You can invest in gold, apparently. Gold is
so commodities is a whole nother thing you can invest in, whether it's gold or pork bellies or orange juice or whatever. You can invest in Bitcoin and crypto. Like there are a lot of things you can put your cash in. Cash is the safest, but it's also, you're going to grow 0.5% a year. So if you started getting really scared, you should put it in cash. There are certain stocks that are more recession proof. McDonald's historically does really well no matter what. Berkshire Hathaway. Again, I don't know enough about bonds. All my smart friends are talking about how sketchy the bond market is right now, so I wouldn't go into bonds.
What about, I heard a lot about investing in those companies that own buildings, so you don't have to buy an apartment per se, but you invest in a company that owns apartments.
Yeah, I don't know much about that, real estate investing, particularly if it's diversified because they own a lot of apartments and whatever. I guess your speculation there, your hope there would be that COVID will improve and the cost of all these apartments will go up, which they will, and that the real estate market, which is a little soft right now, will recover. Yeah. If there's a second awful wave of COVID or something, you could see depreciation. In most cases, Mizel, I think
it's about waiting.
It's about waiting. The lesson is, don't try to be cute and beat the market. Literally, Warren Buffett, who's one of the most famous investors of all time, most successful over his lifetime, He bet a hedge fund whose job it is, like hundreds of employees, their job is to beat the market. That's how they make money. The S&P 500 goes up on average 10%. So he said, 10 years, I bet you the average of the S&P 500 year over year appreciation versus your hedge fund, I bet you the S&P 500 beats you. And it's like 300 employees, their whole job is to beat the market.
Yeah.
You bet them $1 million to be put towards charity, and he won the bet. So it's really, really hard to beat the market.
That's what I read too. Like my whole book was about that.
It's like really, really hard. And like huge companies, people that are literally 10 times smarter than us, and whole teams of them with algorithms and everything, they can't beat the market. So to think that you have an insight, or I have an insight, or he has it, like, is like, forget it. And so trying to beat the market is dumb, and trying to beat the market quickly, like day trading, like, ooh, I see something, it's like, no, you don't. You're seeing little ripples. You got to look out for tidal waves of like shit that you never saw coming that are going to fuck your world up. So if you have,
that's why you have to do research, to me, like to understand what's going on within a company, who's been appointed as the new whatever CEO, like where he comes from,
you can't win that game, because again, an entire hedge fund is doing that research times 1,000.
Yeah.
And they're buying millions of shares. And so whatever little insight you have that you think they're missing,
Yeah.
someone else has already seen it and bet on it, and it's priced into the market. So if you're like, ooh, I think the CEO's sick, and if he's sick, he might have to step down, and that's going to like lower the shares price. So, ooh, okay, ooh, it's like someone else knows that, and it has bet on it millions of shares. So it's already adjusted the share price. And so the thing that you think is going to happen has already happened. So your best bet is to invest in, either, if you're going to pick stocks, really diversify them, lots of different types, some in fashion, some in tech, some in this, some in that, or buy ETFs, park your money there, promise yourself you can sell it and use it if the market's up. But if the market's down, that you're going to ride it. And it has to be money that you're comfortable waiting 3 to 5 years to touch until it rides. And that way, if you wake up in the morning, check your portfolio, and it's down 30%, you're not like, oh my God, I was counting on that money to pay rent this month. What the fuck am I going to do now? Like I'm fucked. That's where you lose. So all the young people that are on Robinhood, never use their margin bullshit. Like never borrow money to invest. Like, you know how Robinhood does this? They give you cash that isn't yours to bet. If you lose and you get margin, so Robinhood literally will be like, Mizel, you have $10,000. Here's an extra $1,000 that isn't yours. You can invest 11,000. That's called being leveraged. You're taking debt to bet. And if you lose the bet, they margin call you, and they're like, cool, we need that money back now. And you're like, well, the 11K went down to 7. So my 10K is down, but also the $1,000 that I borrowed, I've lost. So now I have to take money that I don't have and give it. So people are doing stupid shit on TikTok where they like borrow 10,000, 20,000, 50,000, buy Tesla in the morning, day trade it at night, and they'll make like $5,000 in a day. And you're like, why aren't I doing that? And the answer is because the market's frothy right now, and it's 43 times earnings. Everyone's winning. It feels like you can't lose. So it feels like I should just get a Robinhood and do it. But the answer is, it's just a unusual time, and you will get fucked doing that. And so invest, hold, be prepared to weather a winter that's 3 to 5 years. And if you can hold for 3 to 5 years, you really can't lose in the stock market. You will appreciate sometimes more, but usually 10% over time. And if you just take money, Mizel, every month and put it in and put it in and put it in as it's compounding, that's how rich people, really rich people, don't make money working.
Yeah, rich people get richer. It's the thing is
the like real wealth, like not like I have 800K, like really wealthy people, when they see a 10% return on the stock market, or even if they're playing defense and they're mostly in bonds and they see a 4% return on the stock market, that 4% is
Yeah.
So like the last thing I'll say is like a lot of people's number is $10 million. If you have $10 million and you put it in the stock market and you put it in index funds, you put it in ETFs, 10% a year on average. If you spend 5% a year conservatively and you put back whatever's left, sometimes it'll be 5, sometimes it'll be 2, sometimes it'll be, your 10 million is getting bigger and bigger and bigger. And you're pulling out 5% a year, which is $500,000 that you can live the most extravagant life on. And your pile of money is just getting bigger.
Yeah.
Like that's really the dream, is to be able to live off of the interest, the appreciation of your brokerage account.
Yeah.
While still letting it get a little bit bigger so that that check is bigger every year.
Yeah, that makes sense.
You should look at the FIRE movement. I think you'd really like it. Like I could see you and CJ getting into it. Financial independence and retiring early. It's all about saving half or 60% of your income, investing it, and they have investment strategies.
I heard of it, yeah. Or
I,
like these people who work like crazy until they make like 1 million and then they just invest that they retire, invest that 1 million and just
yeah.
like.
So if you learn how to invest and you and CJ just slowly shovel a couple $100 a month, $1,000 a month, whatever, like it will compound. And
Yeah.
it doesn't feel like much now, but you're going to wake up in 20 years, 30 years and be like, oh my God, I have like a brokerage account that has $600,000 in it. Right. And like, that's where real wealth comes from.